Hello, welcome to Any Answers Answered for October 2021. As ever, Tim and I have chosen a couple of questions from the pages of Any Answers to have a look at. And our first one this month comes from an M. Saeed, and the question is as follows. Holdover relief is the point of the question. Quite simply, a client owns 51% of his company, 49% held by the wife, a trading company, and wants to transfer some of that to his son. The shares of the company are valued at £500,000. The market value of the transferred shares would be £85,000. The simple question is, can the father claim holdover relief? And then the second part of the question, Tim, is can they transfer, 11,800 is the figure in the question, to utilise their annual exemption, with the rest being covered by holdover?
Well, as always, the simple answer is it all depends. It depends on whether or not the company qualifies, or the shares in the company qualify for holdover relief. And if it is a trading company, and we'll assume it is, then essentially the conditions will be met. For many years now, holdover relief has been restricted for capital gains tax and only applies if the disposal is a disposal of qualifying business assets, and these shares presumably will qualify, or it's a disposal that gives rise to an immediate IHT chargeable transfer. And a gift like this to your son does not qualify under the second head because it's not an immediate IHT chargeable transfer. It would if it was into trust for the son, but if it's an outright gift, as suggested, then holdover relief doesn't apply just because it's a gift, but it would apply, as I say, if the shares qualify. But then we've got to establish that the son is UK resident, because if the son were non-UK resident, the holdover relief would allow a gain effectively to be exported to somebody who could then realise it tax-free. So we'll assume the son is UK resident. So yes, holdover relief is available. Now, what if there is consideration equivalent to the annual exempt amount for capital gains tax, currently 12,300? And in fact, one of the posts in answer to this thread did point that out. So the 11.8 was out of date, if you like. And yes, you could claim holdover relief to the extent of the undervalue. So it would be possible for the gain that's deferred to be reduced by the amount of the consideration without triggering a capital gain, as long as that's covered by the father's annual exemption. And that's a sensible planning point. Third point, which is made again by one of the respondents to this question, is that there has to be a joint election. You can't do it unilaterally. So both father and son, donor and donee, would have to sign the joint holdover election. And that's because, of course, the donee, the son, is taking on the future potential liability on the deferred gain. So that's the answer to the question, Giles, although there is one further point I'd make, which is that valuations, well, two further points. The valuations need to be carefully determined. We're looking here at giving away a minority interest out of a controlling interest, maybe 5% out of the 51%. For capital gains tax, that's going to be valued on the basis of a 5% holding. Were we to be concerned about inheritance tax, and I'm assuming not, because at the moment 100% business property relief would apply, we would have to look at the drop in value of the donor's estate, dropping from a controlling 51%, disregarding the wife's interest, down to a non-controlling 46%, could give a considerably higher value for IHT. And then finally, if the father's going to give, say, 5% of the shares to his son, why not get the mother to do the same? Because the same analysis would apply. Oh, not quite finally, if the son becomes non-UK resident within 6 years, then the deferred gain will crystallise. But if the son becomes non-resident 7 years later, then the deferred gain effectively is exported and will be escaped altogether.
As ever, we start with this is quite a simple answer, and we end up with a whole range of complexity, as is usual in tax. A lot of complexity also in our second question. I say question, it's more a statement which we're going to look at, and it comes from Justin Bryant, talking about EOTs, Employee Ownership Trust. Justin says, everyone knows these are being abused for capital gains tax. Thanks to the CIOT, the cat is out the bag, and they even spell out how to do it for those not in the know. And then he has offered in his point a link to a report from the CIOT. Now, Tim, we've talked about employee ownership trusts quite a lot on Tax TV. We've also personally talked away from the cameras a lot about employee ownership trusts. Brilliant things, very, very clever, very, very usable, but they are being abused.
Yes, and I read this report when it was published by the CIOT, and it is quite interesting that the Chartered Institute of Taxation are, if you like, alerting government and HMRC to what they perceive to be weaknesses in the legislation that provides for employee ownership trusts, and those weaknesses are being exploited by tax avoiders, dare one say tax schemers. John Lewis is almost invariably mentioned whenever EOTs are being discussed. The John Lewis Partnership is in fact a company, the shares of which are owned by an employee ownership trust. And one of the ways in which the so-called partners, which is what the employees are described as, benefit is that employees of a company owned by an EOT can be paid up to £3,600 a year of income, bonus if you like, tax-free. And although during the pandemic, I think the most recent February payment to John Lewis employees did not occur. In past years, they've received decent payments under the bonus scheme every year, and 3,600 of that tax-free. So there's an advantage for the employees of an EOT-owned company. But the advantages being talked about in this thread concern the capital gains avoidance. If, for example, I were to transfer my shares in Absolute Accounting Software Limited into an employee ownership trust, that would be exempt from capital gains tax. The consideration could then be provided out of the current distributable reserves, but some of it deferred until the company has made future profit, and I would get all of the consideration tax-free. So there is a significant advantage there. But the abuse that is referred to both in the thread and in the CIOT document, the link for which is given in the thread, is the way in which, for example, a limited liability partnership, which is going to be sold, is first converted into an employee ownership trust owned company, so that the partners, the existing equity owners of the business, can enjoy the tax-free gains that the EOT structure affords them. But then, perhaps a year or two later, the trustees sell the shares to a third-party purchaser. And it is possibly an exit route without perhaps going the full process of the avoidance that I've just described for maybe a large law firm. It could be an exit route for smaller firms of accountants, where these days a big problem is that the traditional progression route from senior manager to partner is no longer as well worn, because the senior managers prefer just to be senior managers on a salary and not take on the risks of being partners. Well, that makes it quite difficult for the older partners to retire. And one solution would be for them to use the EOT route and have the business transferred effectively into an employee ownership trust, and have those retiring partners then paid out by the trustees. So it is possible that could be used as a sensible exit route for those partners who are struggling because younger employed managers don't want to take on the risks of partnership. So there are a whole lot of different ways that EOTs can be used. But anyway, it was an interesting question. Well, it wasn't really a question, but it was posted on the Any Answers section. And yes, I would recommend that Any Answers viewers do have a look at that possibility of using EOTs. It may be that the CIOT intervention does lead, possibly as recently as the forthcoming budget, to a bit of tightening up in this area.
Well, whether they're being abused or not, I think it's fair to say EOT is a hugely important topic and one that a lot of people should consider when dealing with a whole range of situations and a whole range of potential clients. That's all for this month on Any Answers Answered, but we'll be back next month to look at 2 more questions, and perhaps next time it'll be your question that Tim and I are having a look at. For this month, bye-bye.